So now we're going to turn to the firm's decision making in the long run. In particular here focusing on the exit/entry rule. Okay. So as we've already discussed, the optimal quantity is produced where marginal cost equals marginal revenue. And as we showed in the previous video, in the short run, the other decision the firm has to make is whether to produce or not. And in the short run, we interpret that as a shutdown rule, because the firm could always choose to shut down in the short run and just eat the fixed cost. Now, in the long run, there are no fixed costs. And notice here I wrote this as average total cost, but really we just call it average cost in the long run. So profit can be written in per unit terms as price minus average cost times quantity. So the key thing in the long run is the firm profitable? In other words, is price at least as high as the average cost? Okay, so the exit rule for the firm depends on whether the price is at least as high as average cost, in which case the firm is going to stay. But if price is less than average cost, the firm should exit the industry. Okay. And so let's illustrate what this might look like for us then. So here's the firm, graph for the firm. And so here, what we're also going to show now, and here is the industry. And so we'll start off with our supply and our demand. And initially, we've got this equilibrium price here, which of course then we trace back into the firm's graph and say, look, this is the marginal revenue, so the price in the market for the firm. Our marginal cost tells us that for this firm, the optimal level of output is here at Q star, if they're going to produce. So first, let's go ahead and illustrate a case where the firm is actually making a loss. Okay? So in other words, we've got this scenario here, so this firm may want to exit the market. So in this case, what we have is actually that average cost is higher than the price at Q star. Which means, of course, that in this case, right, if price is less than average cost, that means our profits are negative. And so the firm is incurring these losses here. Okay? And so that's the firm's loss, economic loss, right? Pi, profit, is less than 0. So what's going to actually happen in this case? So this firm and other firms in the same situation are going to exit. And they're actually going to exit up until the point where we reach 0 profits. So what's going to happen is, imagine, right, as firms exit the industry, right, think back to the beginning of the course when we said what affects the position of the supply curve, right? What are those shifters, those ceteris paribus conditions? One of those very important ceteris paribus conditions was the number of firms in the industry. So as firms exit an industry, what does that do? Well, that decreases supply, shifts the supply curve to the left. So as firms begin to exit the industry, the supply curve shifts to the left. And remember, as we discussed, when supply decreases, right, when that curve shifts to the left, that means that the price starts to go up. And as the equilibrium price goes up in the market, that means that this marginal revenue curve for the firms starts to shift up. And we continue to see this. Firms continue to exit the industry up until we get to this point here. So our new industry supply curve is given by S prime. We'll call that new price P prime. And when you bring it back in here, right, why is that our equilibrium? Well, because that's the point where price equals average cost. There's 0 profits. Okay? Now, what if instead we had, for these firms, they had lower costs, so that when we start off here at P star, and so here's the marginal revenue curve. Again, here's our marginal cost curve. Now let's say that average costs are actually much lower, and that they are in fact below the price at Q star. Well, in this case, firms are actually making profits, right? Equal to this shaded area here. Right? Price is greater than average cost. Profits are greater than zero. Right? So they're making positive economic profits. Well, what's going to happen in this case? So now here we're starting with the supply curve S. But other potential firms are out there. Remember, we have free entry in a competitive market. So that means that there are other potential producers who aren't currently in the market, right? They're not currently part of this market supply curve. They're out there waiting for better conditions. Well, what are we going to see? Let's say that we get these better conditions, some technological improvement lowered the average cost curve. Now this means that more firms could enter the industry and remain viable, right? In other words, not making negative economic profits. So in this case, when profits are positive, instead of exit, we're going to have entry of firms. So more firms like this one are going to enter the market, and that shifts our supply curve outward. And that will continue until we get down to this price here, the way we've drawn this. And so I'll call that S double prime, P double prime, so at this price, right? And so, or actually just a little bit lower than that. Not drawing this very well here. All right, we're going to get to the bottom of the average cost right here where marginal cost intersects down here, the minimum of average cost, just a little bit lower, and we'll get to down here. Okay? So P prime will equal this average cost. Okay? Right at the minimum point of the average cost curve. Okay? And so the optimal output will actually be here at Q double prime, right? So what's happening is this is actually pushing firms, right? Notice initially in the short run equilibrium, we start with firms are making positive economic profit. They're actually producing at this higher average cost up here, right? Because they're producing up at Q star. Then as firms enter the market, pushes price down, there's more firms taking market share, that pushes the firm's production down to Q double prime here, which is putting them at the bottom of the average cost curve. Similarly, what we saw over here, as firms were exiting, we had the opposite effect, right? Is that output went, instead of being here, output went right up a little bit to here. As firms exited the industry, the existing firms actually increased their production and went up to higher, right? Got a little further down in their average cost curves. Didn't draw it with great curvature here, so I know it's a little hard to see the distinctions between the two. But the important thing that we note here is that if firms are making positive profit, they are here in this example, in the short run, then more firms are going to enter. That shifts the market supply curve outward, puts downward pressure on the price, and then all of the existing firms are actually going to produce less as they move down the average cost curve as the price comes down. When firms are making losses in the short run, that's going to cause firms to exit the industry, causes the market supply curve to shift to the left, price goes up. And in this case, what we see is that firms' output will actually go up because it moves them down the average cost curve. They go from being initially a little higher here to down there. Okay. The key is that in the long run, when we have free entry and exit, economic profit is zero. Okay. Firms will not continue to produce at economic losses. And that would be inefficient. I mean, that would mean that firms are continuing to produce even though those resources are best used elsewhere. And it's important to keep that in mind because what we're talking about here is an efficiency concept. Right? We're thinking about allocative efficiency. Should these firms be producing in this marketplace, or should those resources be freed up to be used in other endeavors, producing other goods or services? And that is what this basic model of competitive firms tells us, is that under the right conditions, when you have competitive markets, we have no externalities in this case, or it's a very simple model, we get this kind of efficiency. Right? We get firms producing on the margin where the marginal cost equals the marginal benefit to the consumers. Right? Marginal cost of producing the last unit of a good equals the marginal benefit to consumers. Right? Firms individually are producing at the efficient level because they are producing where marginal cost equals marginal revenue. So this wraps up the basic notions of how we look at competitive firms making their decisions in the short run and in the long run.